All right, so we're going to talk about Chapter 12. This is probably just going to be one video. It's going to be fairly short. We're going to talk about two major concepts in this chapter, okay? So the first thing we're going to talk about is learning the concept of and being able to calculate a company's cost of capital. Sometimes we'll refer to this as the hurdle rate. It's a rate that you have to get over. We'll talk about that a little more. Then also we're going to learn how to use the net present value, the NPV stuff that we learned from those time value of money concepts that we learned in Chapter 11. We're going to apply those concepts to help us make investment decisions about do we purchase this asset, do we make this investment. So the first thing we got to talk about is how do we calculate a company's cost of capital? Well, to understand that, we got to talk about just a couple of different definitional type items here. The first one is capital budgeting. What is capital budgeting? It's simply just a process that we use to analyze and select long-term investments for the business. Okay, what are we going to do with the capital that we have? Okay, so once you have an expenditure that you identified, once you have an investment that you've identified, you have to generate a satisfactory rate of return for the company. The company has the risk, they want the return, right? This is where cost of capital, or what we call the hurdle rate, comes into play. So this capital can be obtained in three different ways. You can get that through retained earnings, right? The net income that you get to keep after you pay dividends, you can use that to reinvest back into the company, right? Those are your retained earnings. It's called equity financing. It is internal equity. It's the equity that we've generated internally. You can also sell stocks. When you sell stocks, you are selling shares of ownership in your company to external owners. So this is equity financing once again, except now it's external. And then we can do issue debt. This is like bonds, right? We can sell bonds. We can issue bonds. This is debt financing, and again, it's external. What this boils down to is we get to this cost of capital, right? This hurdle rate. This is the return that the investors, that the stockholders expect to see, right? They're the ones with the risk. They're the ones expecting the return, and they expect X amount of percent of return. The way that you calculate cost of capital is you need to calculate it as the weighted average cost of debt and equity financing. So we'll take a look at an example really quickly here. So remember, cost of capital is the weighted average cost of financing, your debt and your equity. You find it by taking your liability proportion, multiplying it times your liability required return. Then you add that to your equity proportion multiplied by your equity required return. So look at an example. It'll make more sense if we actually just look at some numbers here. So let's assume that a company has the following required returns and financing proportions, right? Required returns, they expect a 12% return on liabilities and a 16% return on equity. The financing proportions, they have $1 million worth of liabilities, they have $3 million worth of equity, they've got total capital structure of $4 million. So the liabilities are 1/4 of that, equity is 3/4 of that. We calculate the cost of capital by taking the 1/4 proportion of liability times the 12% expected return. We add that to the quotient of 3/4 of the proportion of your equity multiplied times the 16% expected return, and that gives us 0.15 or 15%. So what does that 15% tell us? Well, what it tells us is if we don't see a return on whatever investment it is that we're making of at least 15%, we won't be able to show a return, get a positive return for our shareholders, and they're going to be unhappy with it. So if we're going to make an investment, we need to ensure that the future cash flows are at least 15% and that we're going to see an actual positive return on the investment. Look at another example here. So let's say that Russell Corporation's capital structure consists of $2,690,000 worth of assets and $1,600,000 worth of liabilities. Joe Russell, the corporation's CEO and largest shareholder, says that the debt has an average interest rate of 9% and that the shareholders want a 16% return. What is Russell Corporation's cost of capital? So the first thing we got to do is we got to figure out how much equity is there. We know assets, we know liabilities, so we can just simply use our assets equal liabilities plus equity formula, and we go, 2.69 million equals 1.6 million plus X, where X is equity, and X equals $1.09 million. So now we know our equity is $1,090,000. So take your liabilities, proportion, or take your liabilities, divide it by your total capital structure, that $2,690,000, you get 0.595 or 5.95%. This is where $2,690,000 is your total liabilities and equity or your capital structure. Then we can do the same thing with our equity, and we get an equity proportion of 0.405. We can calculate our cost of capital as 0.595 times 0.09 plus 0.405 times 0.16, and it gets us 0.118 or 11.8%. That is our cost of capital. That is the hurdle rate. If we are going to make an investment, we need to make sure that the investment has a return or on future cash flows of greater than or equal to 11.8%. Okay? So we keep talking about cash flows, and the way we're going to use those cash flows to make decisions is using what we call net present value. Okay? We're going to make some net present value analysis, and this is basically just a method we use to evaluate investments. It uses time value of money concepts that we talked about in Chapter 11, and it looks at whether or not the investment's expected rate of return is greater than the company's cost of capital or the hurdle rate. So we perform the analysis in 4 steps. The first step is that you estimate the timing and amount of all the cash inflows or revenues and outflows or expenses associated with that investment over its anticipated life. Okay, so you're going to have somebody, you're going to have an analyst that says, hey, this is what we expect the cash flows to be over the next X amount of years. Okay, the next thing you'll do is you'll calculate the present value from Chapter 11 of the expected future cash flows using that cost of capital or that hurdle rate as the discount rate. Okay, so that cost of capital is going to be your R in the formula. Okay, what you get when you calculate this is you get what we call the maximum price. This is the most the company should pay for that asset, or the most that they should invest if they want to earn its cost of capital back. Okay. The third step is to compute the net present value by subtracting the initial cash outflows necessary to acquire the asset from the present value of the future cash flows, right? So basically this is saying take that maximum cost and reduce it by the asking price of the asset, and that's going to give you either a positive or a negative number. So step 4 is to look at that number, that NPV, that net present value, and decide to either make the investment or reject the investment. Okay? If the net present value is greater than or equal to 0, it means you're going to get a return on your money. You are going to meet your hurdle rate or exceed your hurdle rate. If that's the case, if it is a positive number, then you need to make the investment. Okay? If the net present value is less than 0, then the investment needs to be rejected, because what that means is that you will not in the future get enough cash flows to meet your hurdle rate or your cost of capital. Okay, so let's take a really look at an example here. So and this is going to be even cash flows. Your cash flows are the exact same every year. What this boils down, or what this means is it's an annuity, right? Equal periods, equal interest rate, equal payments, right? So you can use your annuity tables for this. So let's say STK company wants to acquire equipment worth $750,000. The equipment is going to save the firm $250,000 per year over the next 4 years. That's an inflow of cash, okay? The cost of capital is 10%. Should the firm purchase this equipment? Well, step 1, we want to identify our cash flows. So in year 0, the year we purchased the piece of equipment, we have a cash outflow of $750,000. Years 1 through 4, we have equal cash flows at an equal interest rate at equal intervals, meaning this is an annuity. So year 1, year 2, year 3, year 4, we've got $250,000 worth of cash inflows at 10%. Okay, so now we need to find the present value of those future expected cash flows. Here are the numbers you can put into your calculator or into Excel to get to your answer. Okay, so we see that the present value is $792,466,000. What that means is the $792,466 today will be worth that $1 million worth of total annuities at the end of the 4 years. So next we need to compute the net present value, then compare the maximum price to the asking price of the asset. So the net present value is simply the present value of the future cash flows, $792,466, less the initial investment of $750,000. We get a net present value of $42,466. We need to accept this investment because the net present value is positive. The asking price is less than the maximum price, so we exceeded the hurdle rate. Okay, we exceeded the cost of capital. Okay. Now, you can ask yourselves a question. Just because it's positive, does that mean you have to make the investment? No, it doesn't. What if it was only $2? Well, then there's some risk built into it, right? Because these are estimated cash flows. We don't know if these are the actual cash flows. And if that $2 is too close to the number 0 to you, then maybe you're a little risk adverse and you don't invest in the asset, right? So really, the higher the net present value, the more likely you are to say yes to the investment decision. So the last thing we'll look at is an example of cash flows that are uneven. This means it's not an annuity, right? We're not going to be able to use that annuity table. We'd have to use the future value of a dollar table. So let's assume that the $750,000 equipment is expected to generate the following cash flows for the next 4 years. So $300,000 year 1, $260,000 year 2, $240,000 year 3, and $200,000 year 4. First step, identify your cash flows. It's the same as above, but you have a cash outflow of $750,000 in year 0, or the current year, the year you're purchasing the asset. Okay, so now we're going to compute the net present value and compare the maximum price to the asking price. Here, if we use our future value of a dollar table, or we use our calculators, which is what I would recommend, you are going to get to $804,522. Now notice you'll have to make each of these calculations separately because your cash flows in each year are different. They are uneven, so you've got to make these calculations separately. Okay, so we have $804,522 as our present value of the future cash. We reduce that by the initial investment or the asking price. We get a net present value of $54,522. Do we accept or do we reject this investment? We're going to accept the investment because the NPV is positive. Okay, so we will work through some more examples in class next time we meet. But if you have any questions about this, please feel free to contact me.